Hello and welcome to Portfolio Matters. We are recording this on the 21st of July and frankly it's been a terrible week for my portfolio, so it's time to recall a really awful trade, actually possibly my worst ever trade and one which I still recall with horror and which bankrupted a former work colleague of mine. But before we get into the gory details, Richard will read the disclaimer.
Thank you, Keith. I have to say it's been a pretty bad week for me too. So my commiserations. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith, let's hear your dreadful worst trade.
Okay, now most of my worst trades we've done, frankly, were more painful than costly, if you know what I mean. They hurt my ego more than my wallet. This one really hurt. And actually this one, I regard myself as being a victim of an institutional fraud, and we will go through this. But first of all, the lessons. Well, the lessons are: don't short. Frankly, as a private investor, you're not smart enough and you don't know what's going on in the market. If I had been an institution, there would have been some information flows I could have had available if I'd been in the know that might have got me out of this. But bear in mind, this trade was common to a lot of hedge funds, and the hedge funds incurred their largest ever loss up until that point on this trade. So it wasn't just private investors who lost money on this. But the big thing about short selling is that your potential downside is infinity, as short sellers in GameStop recently discovered. You can lose a lot of money and your maximum upside is 100%. So the risk reward profile is never great. And frankly, the market can be irrational for longer than you can be solvent. So I'd just be very careful about doing it. The other thing is, as a private investor, I was short selling via a spread betting company. And when things go against you, and this whole disaster was caused by a specific event we'll go into, volatility spikes, and they, in addition to your losses, you get a margin call because they increase the margin on the trade. And the bottom line is, if I'd been able to hold out for 3 days, I wouldn't have incurred an enormous loss. But the margin call meant that I didn't have funds to fund the position, and I had to close it out at an enormous loss. Now, this trade bankrupted a former work colleague of mine and also his colleague. 2 of them went in. And the other thing is, this whole disaster unfolded in Germany, where the Germans have an attitude against what they regard as Anglo-Saxon speculators. And they don't like, for example, short selling. But the reality is that short sellers have a very useful place in the market, and they protected their own. This was, as we'll go through this, you'll see Porsche essentially manipulated the market in Volkswagen in a way that I consider to be fraudulent. Okay, some background. Right, this was late 2008. The great financial crisis was approaching its climax, and as a result, the world was going into recession. Car makers globally, their share price was tanking, and that was particularly true of the US car makers, Ford, GM, and Chrysler, all of which had got a lot of debt and were heading towards what looked like bankruptcy. But in Europe, Volkswagen shares were not falling. They were drifting up. So this is again one of those situations where intellectually I was offended by this piece of what seemed to be total stupidity, that the share price of Volkswagen was drifting up when clearly their business was going down the toilet. So I opened what I considered to be a small spread bet, shorting Volkswagen and buying GM and Ford. And this is the share prices. And you can see I opened it roughly about here. Volkswagen share price is going up, and GM, Ford, Chrysler. In fact, I haven't got all those. I've got Ford, Renault, Ford, and Toyota. But anyway, you'll see global car makers' shares were falling and Volkswagen's were going up. So I opened a spread bet. And I should say this was a very popular trade, both amongst private investors and amongst hedge funds. Now, what happened next? Well, between the point I put the trade on and mid-October, the trade was poor. And then it came good, and it came good very quickly. And at that point, I'd made, frankly, a decent amount of money. And then we went into the weekend. And over the weekend, Porsche announced that they had bought options equal to essentially almost all the shares outstanding. And because lots of private investors and hedge funds had shorted Volkswagen, that meant the effect was there are more shorts than shares available. And the share price absolutely went through the roof. Now, on day one, midway through the day, the shares were up. I think they doubled, just over doubled. And my general policy in these situations is to think this is absurd. I will sit through it and just take the pain. But I didn't like the way that I was behaving, and I took half of it off. And then next day, all hell broke loose. And everyone tried to cover, and the share price essentially pentupled. So, and you can see I both lost on my longs and my shorts. And at that point, I was closed out. But if I'd managed to hold on literally a couple of days more, I would have lost a lot of money, but not the amount I did. And as I said, a former work colleague of mine had put on a spread bet with size £1 million. And his colleague had also done £1 million, and they were both bankrupted by this. So this really hurt. This hurt a lot of small private investors. Okay, in order to understand what happened in 2008, you need to understand the background and the relationship between Volkswagen and Porsche. And it's a story of interconnected families. So Porsche was founded as a consultancy in 1931 by Ferdinand Porsche, who designed the Volkswagen Beetle. But the Beetle was made by Volkswagen, and Porsche has a historic relationship with Volkswagen, in which they have outsourced most of the manufacturing of their vehicles to Volkswagen. So in 1993, Ferdinand Piëch, I think that's the way you pronounce it, who's Ferdinand Porsche's grandson, becomes CEO of Volkswagen. But his family also owns 50% of Porsche, and his cousins own 50%, the other 50% of Porsche. Now, Ferdinand Porsche is contemptuous of his cousins who own the other 50% of Porsche. And to the extent, apparently he had a relationship with his sister-in-law, resulted in 2 children. And then he has appointed Wendelin Wiedeking to run Volkswagen, and Wiedeking decides the best way to consolidate family control is for Porsche, which is a much smaller company, to actually bid for Volkswagen. And so in 2005, it takes a 20% stake in Volkswagen. In 2007, it builds a stake of 30%, and that triggers a mandatory takeover bid. But they put in a lowball bid and it gets no acceptances. So the takeover lapses. Then in 2008, the Porsche board allows Wiedeking to buy up to 50% of Volkswagen. And bear in mind that Porsche is a much smaller company. And so in the background, this is going on. The market knows this is going on. But suddenly it all goes silent. And that is perhaps a warning sign. But one, nobody in the market knew what was going on. And strange things were happening in the Volkswagen shares. So you see, the blue line here is the ordinary shares, and the pink line is the preference shares. And those two should trade in line with each other, as they have done historically. But in 2008, the ords, which have voting rights, massively diverged from the preference shares, which don't. And so hedge funds started to sell the ordinary and buy the preference. And this was a huge trade. Now, the other thing you should know is that the government of Lower Saxony owns 20% of Volkswagen. So as we go into the events of the weekend of the 27th of October, 2008, the share price of Volkswagen has been drifting off. And so, hedge funds finally think, and me, think the trade is coming good. And then on Sunday the 27th, Porsche announced that it owns 42.6% of the ordinary shares, but has options on a further 31.5%, or almost 75% of the company. The government of Lower Saxony held over 20%. So in total, between Porsche and the government of Lower Saxony, 95% of shares are accounted for, but 12% of the shares have been sold short. So 12% short, free float 6%. Classic short squeeze. The share price goes absolutely ballistic. And what Porsche have done is they have exploited a loophole in reporting. If they had built up a larger equity stake using real shares, they would have had to report that to the regulator, and they would have had to make a mandatory bid. But because they bought options, they didn't need to do that. And so they have squeezed shareholders. And so during Tuesday, the Volkswagen share price hits over €1,000. And that, for comparison, its market cap was then 420 billion. Market cap of Apple at the time was 75 billion, Google 110. It was the largest company in the world. So I was short Volkswagen and long Ford via spread bet. And frankly, this is before I kept very detailed records. And I have tried to erase this particular trade from my memory. But I think my bet was about 2 or 3% of the portfolio. On Monday, I closed half of it at 100% loss. On Tuesday, when the shares pentupled, I was forced to close the other half towards the top. Now, from my memory, I think I closed in the mid 850s, and it peaked at over 1,000. But overall, my loss was enormous. So this 2% bet cost me 8% of the portfolio, and was a real lesson. And these former work colleague of mine was bankrupted, and then spent the next decade trying and failing to keep hold of his house. Hedge funds lost an estimated 20 billion. David Einhorn subsequently sued Porsche in the German courts, but frankly got absolutely nowhere, because it was the German courts and the Germans look after their own. So, but the aftermath was not great for Porsche, because it was the financial crisis, and they were trying to take over a much larger company, and they'd borrowed a lot of money to buy the shares of Volkswagen, which were fantastically overvalued thanks to them. And so when it came time to take delivery of the shares, they didn't have the money. And the great financial crisis meant the banks weren't willing to provide funding. Therefore, actually, Volkswagen ended up taking over Porsche, and Wiedeking was fired. So, in summary, don't short. That's it. Number one. Richard, your thoughts?
Thank you very much, Keith. I think it's a very instructive little essay in not shorting the market. I think you made some really interesting points. And one is, using spread betting, you've got a lot of leverage in there. So your actual loss wasn't 100%, it was 300%. Yeah. As an outsider, small investors, we never know what's going on inside the market. And you thought that you had a relatively small position, but because you didn't know what was going on, your actual relatively small position effectively mutated into a much larger position.
Yeah.
And sometimes one of the other lessons, it's not really a lesson here, but it's an observation, that when everybody thinks something is inevitable and obvious, it usually isn't.
Yeah.
But sometimes it is. And you have to remember that it usually isn't. And you're probably usually better off not going into those trades. I just think it's really interesting, Keith. I'm very sorry you had such a bad experience with it. And it's very kind of you to share it with us, because clearly you made it was a very adverse incident in your career.
No, well, in the end, the financial crisis was very good for my portfolio, because I had trades on such as Kazakh Miss, which we've done in separate, and my worst trade on. Yeah. But frankly, this was an incredibly painful experience for me. And as a private investor, you are right at the end of the information line. So reading back through the news, the various options desks knew that Porsche had been buying loads of options.
Yeah. Because they have the inside information, don't they, on the deals being done.
That's right. Exactly. But, hedge funds didn't know. I didn't know. And I mean, I regard this as institutional fraud. They knew exactly what they were doing. When they squeezed the short sellers, and I don't think what we were doing was in any way dodgy or immoral. We were trying, basically the Volkswagen share price had gone up when their business was going through the toilet,
Yeah. And presumably Porsche had some financial covenants on its funding for buying the VW shares, and it needed the price to be up and not to drop. So there was a big imperative for them to maintain the value of the VW shares that they bought. I also think, at the end of even with just doing the share talks, we often realize that we're end of this long chain of information where someone chips in and says, I spoke to X and spoke to Y, and apparently Z is happening in this company, which you didn't pick up on. And It's really difficult to know when you've got all the information.
But, frankly, I've shorted very few companies in my life. And I'd say the hit rate has been really poor because, again, when something seems obvious like this, it's often the case that somebody knows more than you do. And also the market can just stay irrational longer than you can stay patient or solvent. So don't do it, basically. And above all, if you do it, bear in mind that not only when you lose money, not only do you have to cover the losses, but your broker, your spread betting company will increase margin rates, and suddenly you'll get hit with a huge demand for cash. And if you can't meet it, you will be closed out at the bottom.
And short squeezes seem to be becoming more common. Perhaps people are more familiar with the use of options to create short squeezes. They seem to be becoming more. And I think the other point you make is really important, is that the maximum gain you can make if you just put £100, if you short £100 worth of shares with money from your bank account, is £100. And the maximum you can lose is, think of a number.
Yeah. Well, lesson learned, Richard. This was very painful, and thankfully it's a very long time ago now. So anyway,
thank you.
I hope you all benefit from my experience. Now, I hope you'll press like and subscribe to our channel. And in the meantime, it is goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.